what things might look like without having all the management information you need. So I'm going to go down a laundry list of things that I think you should be modeling. And I talked about the valuation. That's really important. Do you value the company based on the market value of the assets, adding back depreciation? Do you do it based on a multiple of earnings? How do you go about determining what the earnings before interest, taxes, dividends, and amortization looks like? What sort of a multiple should you be looking at? And that's important when you're talking about doing a buyout. Now, if you're selling to an outsider, of course, you want to model things with the highest valuation that you can possibly get. But what if it's one of your kids? What if it's a management team that you've had around for a long time? Do you really want to stick it to them with the valuation that's too high? Or do you want to model out what a reasonable valuation might look like, what reasonable terms might look like, and then model what the installment payments look like for you to get your funds for selling your shares and for them to be able to cash flow the expense of buying you out over time. And there's a bunch of different things that you need to think about. What are the tax consequences? The buyer gets to write off the interest, but they don't get to write off the principal. The seller has to think about the fact that they've got to pay income taxes on the interest and capital gain on the principal they received. The buyer cannot deduct the principal, but they can expense the interest. So as one goes down, the other one goes up, and it can impact cash flow. You have to model out the parent owner being taken off the payroll and somebody else coming in to replace them. If you don't model all that out, you might find that the company that is left with the new management team does not have enough cash flow to be able to run their operation. There's no working capital because it's all going into buying out the owner. So modeling the cash flows of a buyout is essential. You might decide, you know what, a 10-year buyout, it's too long and there's plenty of money left over, so we could do a 5-year buyout. Or you might look at a 10-year buyout and say, you know, it's stripping so much of the cash flow of the company that we better extend it to 15 years. The other thing you do as an owner is you look at all the other assets that you have and look at how those are invested and then model out what your cash flow and retirement are going to look like, and that helps determine what the buyout ought to look like. So all of that has to be modeled. If you try to figure out a good buy-sell with a founder-owner selling, whether it's to their own kids or whether they're selling to a management team, if you try to figure that out and you haven't modeled it, you're flying blind. You might as well just have dark glasses on because you're not going to be able to see the impact of it and how it's going to benefit both the buyer and the seller.